Right, the Forex majors trading right now look like this. Dollar yen is hovering near 8-year lows, 102.28. Euro dollar near some all-time highs here, 153.82 is where that pair currently trades. Stephen Rowles is an analyst at CFC Seymour. He joins us now for some analysis. Stephen, that payrolls number, wow, no one really expected that figure. And the market reacted quite sharply to that as well. What does that tell you about everyone's expectations with regards to the U.S. economy and how that perhaps has changed or not changed?
I think it confirmed that the recession is here now, that all the speculators who thought that maybe we weren't in recession, that argument isn't so strong now. And the key to that data that I was focusing on was actually the services sector was down at 12,000 jobs and overall 63,000 jobs, but the key was that service sector. So that really affects the entire retail sales and spending and everything else, because this is really starting to affect the consumer, and the wealth effect has hit us. And the key for data this week will be the retail sales on Thursday. So the fears are really set in. The market's priced in 94% chance of a 75% rate cut next week on March 18th, and we're in agreement with that now. So instead of 50, we now look for a 75 basis point cut to as the Fed tries to help stimulate consumer spending here.
Okay, let's try and take this step by step then. Between now and the retail sales figures on Thursday, at this point, would you be still holding on to dollars, or would you be moving with the rest of the market and dumping them?
I think we're going to see further depreciation of the dollar here against the euro, especially with the ECB continuing to be hawkish. We heard further hawkish comments on the weekend by Weber as well. So with that being said, until we get the retail sales number, look for further declines in the dollar this week.
Okay, 153.82 is where we're at right now against the euro. When you talk about further declines, are we talking about pushing the 155 level?
I think so. I think we'll get to the 155, but I don't see this trend continuing for too much longer. As at the end of the day, especially when you're looking at interest rate differentials, there's not much more room for the dollar to fall, because interest rates can't go down much further here. And this morning I was looking at the CFTC contracts positions in Chicago, and last week actually the euro contracts long positions fell. So I think that there's going to be some sentiment looking at the future here that we could see a reversal eventually, and see a rebound in the dollar as it will eventually become oversold here.
Okay, so if you're looking for a 75 basis point cut by the Fed on March 18th, that brings the Fed funds target rate down to 2.25%. And then after that, what happens?
The million-dollar question today. After that, we think that we could see further declines as the Fed will have to become more and more aggressive on these cuts. Inflation will be put on the back burner. We get inflation on Friday, so the comments will be stagflation coming up for the next couple weeks, months here. So look for further aggressive cuts by the Fed here, but to what level is going to be difficult to say, because no matter what they do, is that going to help these model lines make sure that they continue to be AAA rating, which is the real focus of the entire global markets right now, is the overall liquidity crisis here, and it's not so much of the fundamentals economic sector of the U.S. economy, it's the credit crunch, and the spreads continue to widen no matter what, how low these short-term rates are going.
Which begs the question then, Stephen, despite what the Fed is trying to do, are they basically shooting blanks? Because despite what they do to the Fed funds target rate, that's not going to really help the liquidity crunch, the crisis in confidence that we're seeing in the financial sector. Are they trying to fix a problem with the wrong sort of medication then? What will it take?
Well, they're going to have to continue to cut rates to try to support the consumer, and as the consumer's wealth effect continues to be hurt here, and as the house prices are continuing to fall, and we're seeing some mortgages fall into negative equity positions, the consumer is starting to panic here. So the Fed is trying to protect the overall consumer of the U.S., and with the credit crunch situation, we're seeing what they did on Friday. They'll continue to support by injecting money into the system. So they're really doing all they can do. The overall credit spreads is what can the Fed really do with regards to risk aversion in the global economy. It's all they can do is lower rates right now.
Okay, now let me just shift gears real quick, talk about the yen right now. Interesting because we had some comments out this morning from the Toyota president saying that the yen has strengthened too much and the North American market might be a bit weaker than they had originally forecast. Yen right now stands at the 102 level. Where could we see the yen strengthening even further to then?
Yeah, and we're going to hear that from major CEOs in Japan for the next couple of weeks here, because the average price for the Japanese yen for 2008 for the average company was 106.6. So we're way above that right now. Japan, we get the meetings this week, but just overall, the question is it going to hit the 100 level this weekend or next week? And I don't think so. I think that's a major psychological factor. And will intervention come back into the Japanese market, because the exporters are really getting hurt here? And this affects the whole region out here when you're looking at Korea's currency and Taiwan's currency as well. So direct competition with that yen continuing to fall. So the carry trade is just taking a big break right now as this risk aversion continues to mount.
But, you know, we're also reaching the end of the Japanese fiscal year, a time when repatriation of overseas profits tends to also affect the yen currency. Wouldn't that be another reason to stay away from buying dollar yen right now?
Yeah, that's a very good point. It's seasonally, it just happens every year for sure. So the yen right now is something that it is a focus, but the yen is more of a follower where we're sort of focusing on overall currencies. We have to look at the U.S. direction right now in the credit crunch, and the yen will sort of fall, and it is dictated by other external factors right now.
Okay, and let me ask you about another Asian currency that is in the news today, the Malaysian ringgit. We did have a surprise election result in Malaysia over the weekend. We're seeing some reaction in the financial markets today. Stock market's down 7%, ringgit's down 1% against the U.S. dollar. Where do you see, is this just a temporary sort of knee-jerk reaction, or is the Malaysian ringgit on a bit of a downward trend?
Yeah, I think it is a knee-jerk reaction. It's a headline. Eventually, the bottom line will come back into play. What we're looking at with Malaysia is continued appreciation of the currency to help with inflation. And inflation concerns are going to mount and increase as part of the reason for the early election is we expect that the fuel subsidies will be cut, which will just add to their inflation concerns there. So the best method they have to alleviate those inflation pressures is to appreciate the ringgit, which will be in line with their competitors in Southeast Asia. So across the board, we look for that to happen.
Okay, and just very quickly, if you can, 320.10 is where the ringgit stands right now. Would you be buying at these levels?
Yeah, I think so. I think today is a great opportunity if you're looking at the future here.
Okay,
sure.
Stephen, thanks so much for joining us. Stephen Rowles,
Thanks,
analyst at CFC Seymour, joining us live from Hong Kong. Just ahead, though, we'll